Good morning or afternoon, everyone, and welcome to the ASC Topic 606 5 Steps Presentation with Examples Part 2 webinar presented by Hein & Associates. We are pleased to offer complimentary webinars each month that cover a wide range of finance and accounting topics. I am Shannon Reddy, your moderator and webinar organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted. Please use our chat feature to ask questions. We will save time at the end for Q&A, but also please ask questions throughout as our presenters will be able to answer them. The webinar is being recorded. A copy of the webinar presentation and its recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive CPE credit for this session, you will need to be connected for a minimum of 100 minutes and must answer 75% of the polling questions that are included throughout the presentation. Immediately following this webinar, you will be directed to an online evaluation form that must be submitted in order to receive your CPE certificate for the course. Please check your inbox later today for a follow-up email that will include a link to the evaluation as well. Our presenters today are Greg Fall and Michelle Carr, both partners in Hein's Denver office. Greg provides a wide range of audit and accounting services for both public and privately held companies. He assists clients with financial reporting and complex transactions such as initial public offerings, IPOs, private offerings, and mergers and acquisitions. And he has an extensive expertise in debt and equity finances, share-based compensation, income tax accounting, purchase price accounting, and SEC reporting. He focuses in the alternative energy, technology, and manufacturing and distribution industries. Michelle began her career in public accounting with Hein & Associates in 1999. Since that time, she has primarily worked with technology and software firms, manufacturing and distribution companies, and clients in the mining sector. Michelle serves both privately held companies and publicly traded corporations, overseeing a variety of assurance engagements and consulting projects. Her assurance work has ranged from audits for SEC and IFRS engagements to due diligence services and other agreed-upon procedures. In addition, Michelle provides technical support on complex accounting issues, advises on revenue recognition, inventory, as well as matters of impairment, goodwill, and mergers and acquisition transactions. We thank you for attending today, and now I would like to introduce Greg Fall and Michelle Carr.
Okay, thank you, Shannon, and welcome everybody. Hope everybody was able to join us for the first webinar in this series, and if not, there will be a link sent out with the webinar link for this webinar. We'll send out the link for the first one. So, just by way of introduction and recap of what we covered in the first webinar. Some of the key points is the effective dates and transition methods for adopting ASC 606. In general, for the effective dates, for public companies, that is coming up in Q1 of 2018. So for public companies, they'll be adopting in their first quarter, assuming they're on a calendar year of 2018. And for private companies in general, again with the calendar year end, that will become effective for their 2019 financial statements. Then we introduced the concept of the 5 steps within Topic 606. The first step being identifying contracts with customers. Secondly, identifying the separate performance obligations. Third step, to determine the transaction price. And fourth step is to allocate the transaction price. And fifth step is to recognize revenue when performance obligation is satisfied. If you remember, these are not necessarily a linear approach. Some of these get tackled and, possibly together, maybe a different order. And so for our agenda today, where we left off last time is, we had a polling question to start out with.
We do. So if you could please answer the following question. Did you attend the first webinar? Yes or no? Please make your selection now.
Okay, so it looks like about a third did not make it to the first webinar. And again, I would encourage you to take a look at the previous webinars. These two in particular really go together to fully understand the 5 steps, but the other 2/3 of you were able to attend. And now we'll move on to what we will cover today. So we left off in the first webinar at the 3rd step. So today we'll be talking about step 4, which is allocating the transaction price. Step 5, which is recognizing the revenue when the performance obligation is satisfied. And then we have somewhat of a sundry list of some other topics. Contract cost, which is a new ASC section that came about as a result of this standard. Warranties. We'll talk about principal versus agent considerations. And we have a special guest, Megan McFarland from our Dallas office, is going to talk about some of the oil and gas implications in specific. And depending on timing, we'll get started on presentation and disclosure, although that really kind of leads into the 3rd webinar, so maybe just a high-level touch on that today. And with that, I will turn it over to Michelle to start into step 4.
Thank you, Greg. Good morning, everybody. So if we, as Greg mentioned, we left off at step 3, which was determining the transaction price. So let's move forward and look at allocating the transaction price to the performance obligations in the contract. So the guidance specifically says for a contract that has more than one performance obligation, the entity should allocate the transaction price to each performance obligation in an amount that depicts the amount of consideration to which the entity expects to be entitled in exchange for satisfying each performance obligation. So to allocate an appropriate amount of consideration to each performance obligation, we must determine the standalone selling price at the contract inception, of which the distinct goods or services underlying each performance obligation, and typically allocate the transaction price on a relative standalone selling price basis. If standalone prices are not available, then we're going to have to consider on how to estimate that. So these rules will be in effect for the majority of situations. If you have discounts or you're allocating consideration that includes variable amounts, we've included the specific guidance here in case you need to go through that specifically, and we'll talk about it a little bit further in the slides. But I just wanted to point out that ultimately you'll have to get through determining the underlying sales price, the standalone selling price of each of those components, and then you'll have to determine if you have to allocate that to one specific component or on a pro rata basis throughout the full contract. So what is standalone selling price? It is the price at which an entity would sell a promised good or service separately to a customer. The best evidence of a standalone selling price is the observable price of a good or service when the entity sells that good or service separately in similar circumstances and to similar customers. A contractually stated price or a list price for a good or service is certainly a consideration, but it can't be presumed to be the standalone selling price of the good or service on its own. If there is no observable price of a good or service, we're ultimately going to need to estimate that. And when estimating that, you're going to want to maximize the use of all the observable inputs that exist. And some of those, we'll talk about many of them throughout the slides, but just at a high level, that really may include market conditions or entity-specific factors, the type of customer you deal with, uniqueness of your business, those sorts of things. So what are the suitable estimation methods? So the guidance itself has given us 3 specific methods, and we'll go through these in detail. But it's called the adjusted market assessment approach, the expected cost plus a margin approach, and then the residual approach if you meet certain criteria. So let's talk about the adjusted market approach, or sometimes it's nicknamed top-down approach. So ultimately, you're developing a price of which the market would pay for this good or service. So you're really going to want to work with your entire organization and really all the way down to the sales teams to really be considering what the market conditions out there include. Are you the market leader? If you're a market leader, maybe you're able to get premiums for your products. If you're new to the market, there's the potential that you're issuing discounts. So all of those things are observable inputs that you would use in this method. Other suggestions might be even competitor pricing, market awareness, trends in the marketplace. Potentially you have geographic pricing that you need to consider, or even if your product is customizable, how that impacts the product price or service. So the expected cost plus a margin approach, or bottom-up approach, is pretty self-explanatory in its title there, but it's really a cost-plus method where you're estimating the cost to provide a good or service and then adding a reasonable increase for margin and sales effort. Now, the one thing the guidance doesn't specifically go into is how you determine the margin itself you would include there. And so that may take some significant judgment in really assessing those observable inputs again and really evaluating what your current business model represents and how you've historically done business. So when you have one or more performance obligations that are highly variable or uncertain, a business can use the residual value approach, but you must meet the 2 criteria listed here, which is an entity has not yet established a price for a good or service, and that good or service has not previously been sold on a standalone basis. So if you meet that criteria, then really what the residual approach means is an entity may estimate the standalone selling price by reference to the total transaction price less the sum of the observable standalone selling prices of the goods or services promised within that contract. So it just becomes essentially a formula. I did want to mention one note that the allocation is really done at the inception of the contract, and there's typically isn't an update or changes to those estimates between the inception and the completion of the contract. So when you really assess those, it's definitely worth the effort to get that right on the front end. There are situations with modifications that would allow you to update those estimates. So if you had a modification that was treated as if there was a termination of the existing contract and a new contract was formed, you would have that opportunity to update those estimates and reassess those. If you had a modification whereby the existing contract stays in effect and the new items or the new performance obligations really become part of a separate contract, the original contract would stay intact with its original estimates, and you would only be evaluating the new components to that second contract. So consider whether there's a discount embedded in the arrangement would be applied to one or multiple performance obligations. If the discount applies to multiple performance obligations, it would be allocated on a pro rata basis after applying the residual approach to all the performance obligations. It may be appropriate, so the guidance has given us these 3 approaches that we've gone through here, but it does also indicate that it may be appropriate to use another estimation method or a combination of using multiple approaches to determine the standalone selling price of the performance obligations. So I wanted to mention that because it's not necessarily limited to those approaches. They're giving you suggestions and considerations to really consider. But if there is a different method that really applies the same criteria, which is really identifying the amount the entity would charge if it was sold on its own for that good or service, then you may apply a different approach. So these methods and approaches are different from what was used prior in multiple element arrangement guidance. And I think we mentioned it a few times in the first webinar, but there is no mention of VSOE or the tiers that would follow under the current guidance. So this could ultimately lead to different result and substantially change your revenue recognition if you have multiple performance obligations. It is our assessment that it's likely that revenue recognition will be recognized earlier under this new standard versus under the multiple element guidance currently in effect. There is much flexibility in this area of the standard, and it's going to take some consideration for tailoring to your specific needs. And there is some discussion out there with the TRG and other places that indicate that potentially a range of prices in determining your standalone selling price may be acceptable as well, depending on the circumstance. So let's move through an example for step 4. A company enters into a fixed price bundled contract to deliver software licenses, implementation services, and 1 year of telephone support. The company believes it can directly determine the standalone selling price of the telephone support based on substantive renewal rates. There is no observable standalone selling price for the software license, and the company believes it can estimate using one of the prescribed approaches. So the implementation services don't constitute significant customization or modification. There haven't been many clients who have contracted for these services, and when they have, they've deviated substantially. Therefore, the pricing is considered highly variable for these services. So the company would be permitted to use the residual approach. They've met all the criteria to allocate a portion of the transaction price to the implementation services, as long as the company's output represents what it expects to be entitled in exchange for the services. So just as a recap, you had telephone support, which we use an observable selling price for. You had licenses, which they're going to estimate, and then you've got implementation services that is being calculated based on the residual approach. So this is, in my opinion, a good example to show how multiple different approaches lead towards the final product. So here's the second example. An entity enters into a contract with a customer to sell products A, B, and C in exchange for $100. The entity will satisfy the performance obligations for each of the products at different points in time. The entity regularly sells product A separately, and therefore the standalone selling price is directly observable. Standalone selling prices of products B and C are not directly observable. Because the standalone selling prices for those products are not directly observable, still going to need to estimate them. And to estimate the standalone selling prices, the entity has decided to use an adjusted market assessment approach for product B and a cost plus margin approach for C. In making those estimates, the entity uses all the observable inputs. So this shows you, how those break down in the use of each of those different items. So we've come up with a total selling price of $150. So as we move forward, we realize that the contracted price is only $100. And so how does this really get allocated? So the entity considers whether it has observable evidence about performance obligation, which the entire discount belongs and concludes that it does not. Consequently, discount is allocated proportionately. So this really shows you the math behind that equation, taking the original standalone selling price divided by the sum of those selling prices times the contract rate, and apportionately concluding on those values to get to $100. Hopefully that helps with step 4. We do have a polling question. Do you want to read it, Shannon? Go ahead.
Thanks,
Sorry.
Michelle. I was going to help.
I appreciate it. Question number 2. Which method will you likely use to determine selling price of your performance obligations? Please make your selection from the following. Adjusted market assessment approach / top-down approach, expected cost plus a margin approach / bottom-up approach, residual approach, or a mixture of the approaches. Please make your selection now. So the results here, as I would expect, really seeing a mixture of approaches being used in that analysis. I just wanted to make sure that I got that point across, that is certainly acceptable. So I will pass it back on to Greg.
Do we want to see if there's any questions on step 4?
Sure. Yeah.
See any in particular? So.
Okay. Please feel free to use the questions feature to ask questions throughout, as we'll answer them.
And we'll have time at the end also for questions. Sometimes can be beneficial to stop in between sections. So then we'll move on to step 5, which is recognizing revenue when or as the performance obligation is satisfied. So core question here is the revenue recognized over time or as of a point in time? And there's very specific criteria for when we can recognize revenue over time. And then if it defaults to point in time, the question is, what is that point in time? Another core element of the standard is we really focus on control. And when does that control pass to the customer? And that's really, kind of the guideline to make these determinations. So on the next slide, we can see that control is defined as the entity's ability to direct the use and obtain substantially all of the remaining benefits of an asset. And the second point here is that control should generally be assessed primarily from the perspective of the customer. So again, whereas legacy GAAP, we're focused more on the company, here we're shifting that focus more towards the customer. And when do they obtain control and start enjoying the benefits of the asset? So some of the examples that the standard provides as to when substantially all of the remaining benefits of an asset transfer to the customer. Some of the indicators would be the ability to use the asset to produce goods or provide services, the ability to use the asset to enhance the value of other assets, the ability to use the asset to settle liabilities or reduce expenses, or pledging the asset to secure a loan. So those are just some examples that are incorporated into the guidance as to how to look at when the remaining benefits of an asset are transferred. Okay, first we're going to look at when it will be appropriate to recognize revenue over time. And we have 3 criteria, and these are, you notice we've highlighted the word one of the following. So it's any of the following 3 items determine whether revenue can be recognized over time. The first criteria is the customer simultaneously receives and consumes the benefits as the entity performs. So a simple example here would be a service contract where we're providing services to a customer and they're obtaining the benefits of those services as we're performing our work. The second alternative would be the entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. So again, we're looking at control in that aspect. And then the third alternative is the entity does not create an asset that has an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. And we're going to look at each of these criteria separately in a little bit more detail. So first, the simultaneous receipt and consumption of benefits. So one of the key points in the standards here is if it's not readily apparent, such as my example of a service contract, and even a service contract such as, let's keep that very simple, like a cleaning service, wherein it's very clear that the benefits are being passed to the customer as the service is being done. If not readily apparent, then we'll recognize revenue over time if the entity determines that another entity would not need to substantially re-perform the work. So in the basis for conclusions in the standard, they give an example which kind of shows how this was debated. The example is a freight company which has a contract to transport goods from Vancouver to New York. Now, one argument of that might be that there is no benefit to the customer until the goods are actually delivered in New York. But what the FASB concluded on this topic was that the customer actually does benefit as the company performs, since, for instance, if it got shipped from Vancouver to Chicago, another freight company could pick it up in Chicago and transport it to New York. So that's kind of a good way of thinking about this criteria here when it comes to re-performance. So in that instance, they concluded that would be subject to recognition over time based on that criteria. So the second alternative then is the customer controls as the asset is created or enhanced. And again, we're on that word control. So if we remember just a few minutes ago, we defined control as being the entity's ability to direct the use and obtain substantially all of the remaining benefits of an asset. So you look back at that guidance to make a determination as to whether the customer is controlling the asset as it is being created or enhanced. And then for the third criteria, remember back on that, it's actually a two-step criteria where both of these have to be made, first have to be met. So we'll talk about an asset with an alternative use first. And for an asset to not have an alternative use, you look at is the entity restricted contractually from readily directing the asset for another use, or is it limited practically from readily directing the asset in its completed state to another use? So the rest of this guidance here on the slide talks about the fact that the determination is made at contract exception, and generally it's not updated with the exception of certain contract modifications, which is very similar to what Michelle was talking about in step 4. So again, we're making these determinations generally at contract inception. So to move on for an asset with an alternative use and how we look at that to make that determination, the first part of this is similar to the previous slide, and then we discuss the fact that a contractual restriction must be substantive. So we're looking to whether that contract restriction, if there is one, is a substantive. So a contractual restriction is substantive if a customer could enforce its rights to the promised asset if the entity sought to direct the asset for another use. In contrast, a contractual restriction is not substantive if, for example, an asset is largely interchangeable with other assets that the entity could transfer to another customer without breaching the contract and without incurring significant costs that otherwise would not have been incurred in relation to that contract. And we're gonna go into that a little bit deeper here on the following slides, but that's really how we're looking at the asset with alternative use. And then for the second option for an asset to not have an alternative use is there has to be a practical limitation on an entity's ability to direct the asset for another use. And this would be the case if an entity would incur significant economic losses to direct the asset for another use. So what's a significant economic loss? That could arise because the entity would incur significant costs to rework the asset for another customer, for instance, or would only be able to sell the asset at a significant loss. So that's what we mean by the practical limitation, as opposed to the contractual restriction. So then we'll move on to what is an enforceable right to payment for performance completed to date. About at this point, we're realizing that we could be building a nice big decision tree just to get through step 5 here. Stay tuned on that. Perhaps in the next session we'll see what that might look like. But so for the company to have an enforceable right to payment for performance completed to date, first look at the terms of the contract along with applicable laws. And so again, we've talked about this before in this presentation, but there may be times where we have to get the outside counsel involved to determine, based on applicable laws, do we have a right to payment under these contracts? Because that is a criteria that must be met for recognition over time. The other part of it is that at all times the company must be entitled to an amount that at least compensates for performance completed to date. So that's kind of a bar that you can't go underneath. You have to always be entitled to compensation for what you've completed to date. So then back in the implementation guidance, it provides some considerations to determine when the entity is entitled to an amount that at least compensates for performance completed to date. So recovery of the cost incurred plus a reasonable profit margin. Again, similar to some of the discussions in step 4, there is that reasonable profit margin that must be met. The other consideration is whether enforceable right to demand or retain payment if the contract were terminated for reasons other than failure to perform as promised. So we can disregard the fact that if we don't perform, we would not be entitled to payment, and just look at the fact that based on the terms, we're doing everything that we need to do under the contract. Would we be entitled to payment for performance to date that includes recovery of the cost plus a reasonable profit margin? So once we get through that, and if our conclusion is that we're going to recognize revenue over time, then one of the next questions would be how do we determine how to recognize the revenue over time? The standards provide the overall objective, which is to depict an entity's performance in transferring control of goods or services promised to a customer. So there's that control word again. We're looking at when is the customer obtaining control of the goods or services promised. And again, this is another area that will require a high level of judgment. But the standard outlines that there's output methods and input methods, and we can see here some examples of output methods. I'm not sure these changed dramatically from legacy GAAP. If we were looking at like a percentage of completion accounting, the input methods, labor hours, cost incurred, machine hours, et cetera. Some of the output methods, though, are, you could do a survey of performance. You get appraisals of the results achieved. You may have milestones within the contract that indicate when revenue should be recognized, the time elapsed under the contract, or units produced or delivered. So then a couple additional points on that is that we're required to use a single method of measuring progress for each performance obligation, and that should be consistent to similar performance obligations. An element of constraint here is that the company must be able to reasonably measure progress towards completion. So again, this is somewhat similar to legacy GAAP. We must be able to reasonably measure progress towards completion in order to utilize the recognition over time. Some of the differences there would be in what you do if you're not able to reasonably measure progress towards completion. So for example, you may need to only recognize revenue up to the amount of cost that you've incurred on a contract, but not factor in any profit margin there. But still, you'd have revenue recognized at least up to the amount of cost that you've incurred, and recognize an equivalent amount of cost, so basically a zero margin at that point in time. Okay, so then if we are not recognizing revenue over time, the only other option is to recognize as of a point in time. And that point in time is when control of the goods or services is transferred to the customer. And the key question here is when does that control pass to the customer? Some of the indicators that are provided, and these are indicators, are there's a present obligation for the customer to pay. That customer has obtained legal title, taken physical possession. They have the risk and rewards of ownership, or customer acceptance. And again, none of the indicators are meant to individually determine whether the customer has gained control. For example, while shipping terms may provide information about when legal title to a good transfers, they are not determinative when evaluating the point in time at which the customer obtains control. That certainly is going to be an element of differential between legacy GAAP and the new standards as to how we look at how that control passes. I think typically we tend to look at more legal title as opposed to some of the more qualitative factors that the new standard incorporates. Now I want to spend a little bit of time talking just about customer acceptance provisions. Historically we've run across this, and legacy GAAP, it takes a fair amount of judgment. I think it's still going to take a fair amount of judgment. But ultimately when customer acceptance provisions exist within the contract, first we look at, can we conclude that the customer acceptance is really just a formality, such as if we could do a quality control determination before the product leaves our shop and is shipped to the customer, where that's just the product is simply meeting size and or weight specifications. That would be fairly easy to determine that customer acceptance is really much more of a formality and should not prevent recognition of revenue. Then another key point is if the revenue is recognized before customer acceptance, then the entity should consider whether there are any remaining performance obligations, such as the installation of the equipment, and evaluate whether to account for them separately. So sometimes those customer acceptance provisions may be indicative that there's another performance obligation that should be evaluated here. And if an entity cannot objectively determine that the good or service is in accordance with agreed upon specifications, then the entity would not be able to recognize the revenue until customer acceptance is received. So with that, we have a few other topics before we jump into some examples here in Step 5. And these kind of still fit within Step 5 in certain ways, so we wanted to cover them here. The first one is consignment arrangements. Certainly not uncommon. Historically, we've seen many of our clients that work under consignment arrangements. And some of the indicators as to whether a contract results in a consignment arrangement and therefore revenue would be not recognized until it's sold through. The indicators would be the product is controlled by the entity until a specified event occurs, such as the sale of the product to a customer. The entity is able to require the return of the product or transfer the product to a third party, or the dealer does not have an unconditional obligation to pay for the product, although it may be required to pay a deposit. So again, here there's not a lot of difference, really much difference, any difference from legacy GAAP, but you need to just look at the indicators. If it appears you may have consignment arrangements, look at these indicators to make that determination. And again, we'd defer the revenue in those scenarios until it's sold through by the customer. Another topic to touch on is bill and hold arrangements. So if you're not familiar with bill and hold arrangement, basically what that is typically in a manufacturing environment. And if I'm the manufacturing, my customer may ask me to produce a lot of goods under a purchase order, but they don't want shipment of those goods, perhaps because they don't have warehouse space or for a variety of reasons. So what we're going to do as the manufacturer is build the product, set it aside in our warehouse, and ultimately store it for them, and then we'll ship it as the customer requests it or they get orders from their customers. So we may be shipping directly to their customer, or perhaps we're shipping to them at a later date. Now the guidance in legacy GAAP for bill and hold arrangements, there was nothing in the actual FASB guidance related to this, and we had to look to SAB Topic 13, which is the SEC guidance, which actually became generally accepted, and by and large we would look at that for private companies as well as public companies. So just because it's in SEC guidance does not necessarily mean that it was only applicable to public companies. Under ASC 606 now, we are incorporating that formally into the FASB codification outside of the S series for the SEC topics. And here are the criteria that must be met to recognize revenue under a bill and hold arrangement. So the reason for the bill and hold arrangement must be substantive. The example would be the customer has requested us to store the product for them. The product must be identified separately as belonging to the customer. For example, segregating that in the warehouse so that it's not part of the common inventory that can be pulled for shipment. The product must currently be ready for physical transfer to the customer, and the entity cannot have the ability to use the product to direct it to another customer. So in other words, it can't be just general inventory items that they could use for another customer and then build another item to fulfill for the bill and hold type customer. So in comparison to legacy GAAP, the key element that I see is missing here is SAB Topic 13 required that there be a fixed delivery schedule for products under bill and hold arrangements in order to recognize revenue. And quite honestly, that was very typically that could be the one to hold up revenue recognition under bill and hold. Some practitioners would interpret that as there needed to be an exact specific date. Sometimes you might look at, okay, we've got a rolling budget, and this is when we expect to fulfill the shipment of these goods. So there was a little bit of variance in practice there. And that criteria is removed under Topic 606. One of the recent developments then is that SAB 116, Staff Accounting Bulletin 116 from the SEC was just issued. It's been within the past month, I would say, and they have come out and said, the SEC has come out and said that once 606 is adopted, then Topic 13 and their staff accounting bulletins will no longer be applicable. So we were kind of waiting to see when that would happen or exactly what they were going to do, but that has been resolved as of this point in time. So once Topic 606 kicks in, then Topic 13 within the SEC literature will no longer be applicable. So another topic worth mentioning is licensing. And this is actually a very, very big topic within the codification. It's warranted a lot of debate and has had some ASUs that have continuously come out to update the guidance on it. We're not going to spend a lot of time on it here because it can be very specific to certain types of entities. So we didn't want to spend, a half hour going through licensing topics when it likely is applicable to a handful of types of companies. So just to give you some examples of what the licensings of intellectual property may entail. Software is included there, and you'll see this, the parenthetical guidance there. I'm going to jump back to that in just a moment. Some other examples are motion pictures, music, other forms of media and entertainment. Franchises would be incorporated here. Patents, trademarks, copyrights. Another key point is that the product must be identified separately as belonging to the customer. So if we jump back up to software and just quickly to explain what that's getting at with parenthetical guidance, 985-2015-5, that is software capitalization requirements for software companies. And what that says is that the customer has the contractual right to take possession of the software at any time during the hosting period without significant penalty. And they can feasibly either run the software on its own hardware or contract with another party unrelated to the vendor to host the software. So that's basically, a way of thinking about the software as standalone functionality once that software is sold to the customer. And why that is important is it may be determinative as to whether that revenue gets recognized as of the point of sale of a bundled contract, or whether it's required to be recognized over time during the course of that contract. So continuing on with licensing, I apologize, I see a typo here. This should say nature of IP. So again, whether you recognize the revenue over time or as of a point in time, that's going to depend on the nature of the IP. And the standard defines two different types of IP. The first one being functional, meaning it has significant standalone functionality, which is kind of what we were driving towards with the software discussion a moment ago. Or is it symbolic, where it does not have significant standalone functionality? Generally, for functional IP, you will recognize revenue at a point in time, and for symbolic IP, you're going to recognize revenue over time. With that, let's jump into a couple examples. The first one is a little bit more specific in talking about, if we remember the criteria for assessing when a product has alternative use to the company manufacturing or selling it, and there's an enforceable right to payment. So in this example, there's a contract to provide consulting services. With that consulting service, the difference between the very basic service contract I was describing earlier to this one is, think in terms of us as auditors, and we're providing a professional opinion at the end of our engagement. The professional opinion relates to facts and circumstances specific to the customer. And the contract requires the customer to compensate the entity for its costs incurred plus a 15% margin. And that 15% margin approximates the profit margin that the entity earns from similar contracts. So first we're going to look at determining whether the customer simultaneously receives and consumes the benefits of the entity's performance. So this is that piece is the first alternative to determine whether you can recognize the revenue over time. And in this case, if the entity were to be unable to satisfy the obligation and the customer had to hire another consulting firm to provide the opinion, the other consulting firm would need to substantially reperform their work. So based on the nature of the professional opinion is such that the customer will receive the benefits of the entity's performance only when the customer receives the professional opinion. So the conclusion here is that the first alternative for recognition over time is not met because it's not because that work would need to be reperformed if there were a change in service providers, if you will. However, then we can look at the third alternative to determine if the development of the professional opinion does not create an asset with an alternative use to the entity. So, using my example of a CPA firm doing an audit work, we're not creating work that would have an alternative use to us. Therefore, that creates this practical limitation on the entity's ability to readily direct the asset to another customer. But the second criteria we also need to look at, does the entity have an enforceable right to payment for its performance completed to date? And if you remember in the setup for the example, the entity, or us as the CPA firm, if you will, we would be entitled to payment for performance completed to date plus a reasonable profit margin. And therefore, we do meet the third alternative here, and we can recognize the revenue over time. And that slide really just says what I just said, so we can move on through it. Okay, and the second example in step 5, this is a much more comprehensive example to walk through all the criteria we've talked about here. So in this example, the entity is developing a multi-unit residential complex. The customer enters into a binding sales contract with the entity for a specified unit that is under construction. Each unit has a similar floor plan and is of similar size, but other attributes of the units are different. For example, the location of the unit within the complex. So in case A, we're asking, does the entity have an enforceable right to payment for performance completed to date? In this case, the customer is paying a deposit at the inception of the contract, which is refundable only if the entity fails to complete the construction of the unit in accordance with the contract. The remainder of the contract price is payable on completion of the contract when the customer obtains physical possession of the unit. If the customer defaults on the contract, the entity only has the right to retain the deposit. So they're not entitled to any additional consideration, only the deposit that was paid up front. Because the entity does not have a right to payment for work completed to date, the entity's performance obligation is not an obligation satisfied over time. And instead, the entity is going to account for the sale of the unit as a performance obligation satisfied at a point in time in accordance with 606-25-30. So this was an example where because of the payment structure of the contract, it forced the company to recognize as a point in time, which likely would be final delivery of the unit to the customer. Then in case B, we're going to look at how that differs if there is actually an enforceable right to payment for performance completed to date. And in this case, the contract has substantive terms that preclude the entity from being able to direct the unit to another customer. The customer does not have the right to terminate the contract unless the entity fails to perform. And the courts have previously upheld similar rights that entitle the developers to require the customer to perform, subject to the entity meeting its obligations under the contract. So what you can see here is this is a writing of the FASB who threw every qualification in there that they could, but ultimately what we're getting at is there's an enforceable right to payment. And in this case, the entity does determine that the asset created by the entity's performance does not have an alternative use to the entity because the contract precludes the entity from transferring the unit to another customer. And also, the entity has the right to payment for performance completed to date. And as a result, the entity will be able to recognize the revenue over time. And then to recognize the revenue for that performance obligation, the entity measures progress towards complete satisfaction of its performance obligation in accordance with the guidance we talked about, including input and output methods. So to go on and subparagraph 180 just points out that the entity would account for each contract for that development separately. So in this case, you wouldn't bundle the contracts. You've got to look at each contract for the development separately and account for each one differently. Then we had case C, which really is same facts as in case B, except in the event of default, the customer default by the customer, the entity can require the customer to perform as required under the contract, or the entity can cancel the contract in exchange for the asset under construction. So just slightly different terms here. Ultimately, the conclusion here is that we'd still be able to recognize over time because the entity has a right to payment for performance completed to date, because the entity also could choose to enforce its right to full payment under the contract. And with that, I think we're going to move to another polling question.
Yes, we do. Will identification that control paths be easily identified by the organization? Please make your selection from the following: yes, no, or not sure.
Okay, looks like most everyone has had a chance to respond to that, and as to whether the identification of control passing will be easily identified, about 45% answered yes, 22% no, and several of us are not sure still at this point in time. So that's a very good point. You know, this could be readily apparent in some cases, and in some cases it is going to take a fair amount of judgment. That's going to be very entity specific and potentially specific to an industry as well. And with that, why don't we move on back to Michelle.
So at this point, we've completed the 5 steps. We have several items that we want to go through that really fall outside of those steps but are beneficial to be aware of in going through your process. So the first one really relates to contract costs. The FASB gave us ASC 340-40, which really helps us with other assets and deferred costs relating to contracts. So an entity shall recognize as an asset the incremental cost of obtaining a contract with a customer if the entity expects to recover those costs. The costs that would not have incurred if the contract had not been obtained. So let's say you can capitalize. So for example, a sales commission, or even a situation where a sales person's salary directly changes because of that, potentially might qualify. If it was going to occur either way, whether you won the contract or lost the contract, those costs would be expensed. So costs specifically related to fulfilling the contract require capitalization if all of the following criteria are met. So costs relate directly to a contract or to an anticipated contract that an entity can specifically identify. So that's direct labor related to setup activities, potentially. The costs generate or enhance resources of an entity that will be used in satisfying or continuing to satisfy performance obligations in the future. So an example of that might be the activities giving rise to the cost. Oh, well, let me restate that. So I wanted to point out that activities giving rise to the cost are not performance obligations in and of themselves. This is only enhancing the company or the ability to provide the service or the other performance obligation. And then the costs are expected to be recovered. So it's based on net future cash flows from the contract, and you can include expected contract renewals as well if that's applicable. So some examples of costs that relate directly to a contract would be direct labor, salaries and wages, direct materials or supplies, allocation of costs that relate directly to contract or to contract activities. So that might even be the supervision over those projects directly, or insurance that you had to obtain specifically, things like that. Costs that are explicitly chargeable to the customer under the contract, and other costs that are incurred only because an entity entered into the contract. So an example of that would be subcontractors. As we continue to say, there may be significant judgment related to determining whether these costs generate or enhance resources that will be used in satisfying performance obligations in the future. So some ways to consider looking at that might be, is it being recovered through explicitly stated reimbursed costs in the contract, or even through the margin that's built into the contract? So costs that are expensed as incurred would be general and administrative costs, wasted materials, labor, or other resources, costs that related to satisfied performance obligations. So I just want to point that one out specifically, because that once you've satisfied that performance obligation, you're really moving forward and addressing whether they apply towards the ones that remain unsatisfied. Costs for which an entity cannot distinguish whether the costs relate to unsatisfied performance obligations or to satisfied performance obligations. So some costs that I was relating to my own personal clients might be credit evaluations or legal expenses that are incurred relating to getting those contracts reviewed and prepared. Those would all be expensed. So we've included this slide here to show you there are some other areas out there that are specific to certain areas, so inventory, PP&E, other expenses. So all of these categories would apply before the guidance we've just discussed on contract costs, so ASC 340-40. If any of these apply, they would preclude using 340. So keep that in mind. So if these criteria are met, the fulfillment costs would be capitalized. And I just wanted to point out it's not really a choice. If you've met that criteria, you are required to capitalize and create an asset for those. There is a practical expedient. The incremental cost of obtaining a contract, if the amortization period would otherwise be 1 year or less, may be expensed. So capitalized costs relating to obtaining a customer contract or fulfilling a contract would be amortized in a manner that is consistent with how the related goods or services are transferred to the customer. So currently, if you're amortizing sales commissions over a non-cancelable term of the initial contract, your amortization period may be assessed differently under this guidance. So I do have one example to go through here. An entity enters into a service contract to manage a customer's information technology data center for 5 years. The contract is renewable for subsequent 1-year periods. The average customer term is 7 years. The entity pays an employee a $10,000 sales commission upon the customer signing the contract. And before providing the services, the entity designs and builds a technology platform for the entity's internal use that interfaces with the customer system. That platform is not transferred to the customer, but will be used to deliver services to the customer. So the entity recognizes the asset for $10,000 incremental costs of obtaining the contract, the sales commission, because the entity expects to recover that through future fees for services to be provided. And then the entity amortizes the asset over 7 years because the asset relates to services transferred to the customer during the term, and they do anticipate that the contract will be renewed for 2 subsequent 1-year periods. So the initial costs incurred for the technology platform are listed there in the table. So they've spent $350,000. And how do we treat that piece of it? So the initial setup costs relate primarily to activities to fulfill the contract but do not transfer goods or services. So we're really going to have to look at the hardware costs, and it's going to have its own specific guidance there. And so nothing will, I mean, it probably won't change from the way it's been historically treated, as well as with the software cost that has specific guidance on internal use software. But the cost of design and the migration and testing of the data center would fall under 340-40 to determine whether an asset can be recognized for cost to fulfill the contract. Any resulting asset would be amortized over the systematic basis over the 7-year period, which we've discussed how they came up with that period, that the entity expects to provide services related to the data center. So hopefully this example is helpful to show how the separate standards will apply and how those will get combined together. I think we have a polling question. We do. Do you anticipate substantial contract costs to be capitalized? Please make your selection from the following: yes, no, or not sure. Great, here are the results. And we actually have some questions that also came in. First one is, please expand on some examples of symbolic IP and why it should be recognized over time.
Okay, so this question is going back to our Step 5 analysis, and in particular the licensing guidance. So symbolic IP, maybe to take a software example initially, an example would be that, for instance, we deal a lot in NetSuite, which is a accounting package that's a software as a service. So with that, even if it encompasses a license when you sell it, because that software as a service, it doesn't have a standalone functionality. And absent that standalone functionality, that's the reason that it gets recognized over the term of the contract as opposed to at the point in time that the license is technically delivered, if that were to be the case. On the other hand, if it were software that you download onto your servers and you're able to utilize that separately, that would fall into the functional IP, which may qualify for recognition immediately. Another example may be like a license for a patent, which sometimes those may be functional IP or they could be symbolic IP. It probably is going to depend on the nature of the patent, but let's take an example where there's a patent that has been developed and we're selling that to a customer, but in order for the customer to obtain benefits from that patent, there's going to be significant research and development and further development of products to come off of that patent. So we agree, as part of our contract, we agree that we're going to work with them throughout the research and development process. So in that case, there would not be the standalone functionality to qualify as functional IP, and therefore it's going to be symbolic IP, which would be recognized over the term of that contract. So hopefully that sheds a bit of light on the difference between symbolic versus functional.
Great, thank you, Greg. We actually have another question as well. Please address sales commissions as contract costs. Okay, so in terms of sales commissions being a contract cost, they would have to be specific to that contract, whether they were earned specifically in closing and signing that specific contract. So if that expense would have not occurred, then it would, let me rephrase that. If it's only incurred because of the closing of that contract, then it would become a contract asset. So hopefully that answers your question. If there are more specifics, certainly send us some more information. All right, we'll move on to the next slide.
Okay, so next we're going to talk a little bit about warranties. Warranties, as it turned out, ended up being a fair amount of debate when what ultimately became Topic 606 was released as an exposure draft. In the end, I think what we'll see here is that there really is not significant deviation from legacy GAAP in terms of how to account for warranties, but I do think it's very important that we address it here and give an overview of what the requirements are. So there's two types of warranties as they're defined in the implementation guidance of 606, and that's an assurance type warranty and a service type warranty. So a service type warranty first. One example would be there's an option to purchase the warranty separately. For instance, I'm sure we've all been, going through a retail outlet or a retail store and checking out, and the salesperson always wants to sell you that extended warranty. So that would be an example of a service type warranty where you're paying for that separately. Then it also provides the customer with service in addition to assurance that the product complies with agreed upon specifications. So some of the considerations and indicators for a service type warranty is whether the warranty is required by law, the length of the warranty coverage period, and then the nature of the task that the entity promises to perform. So again, another area for judgment. Another consideration to keep into account here is what are the common warranty practices within the industry, and what's my company's past practices with regards to warranties. Those may be indicators as to which type of warranty we have. The Transition Resource Group used an example whereby a luggage company provided a lifetime warranty to repair broken or damaged luggage. In that case, it was determined to be both assurance type and service type. And some of the considerations there is there's no law requiring the warranty. However, the length of the warranty is ultimately for the life of the product. And then the other consideration was the tasks include both the repairs to the luggage that do not meet agreed upon specifications, which would be your assurance type warranty, and repairs for broken or damaged luggage, which is the service type warranty component. So then what to do, why do we care about that differentiation? So for assurance type warranties, we look to ASC 460-10, which deals with guarantees, and that's going to determine how we account for it. Basically accruing a liability as of the date of sale for estimated warranty liabilities. However, if it's a service type warranty, we need to evaluate that as a separate performance obligation. So that's going to receive a component of the overall transaction price that's been determined. So really the only significant difference between legacy GAAP here is that with the service type warranties, those now will be allocated based on relative standalone selling price. So if recall back and how we allocate the selling price, that's on a relative basis, so it's kind of proportionate. Whereas under legacy GAAP, the full standalone selling price was allocated to the warranty. So really the only key difference there with warranties. So another consideration worth a bit of discussion, but again, this can be rather specific to specific entities, but principal versus agent considerations. An example of this, just so we can make sure we understand what it means, principal versus agent, and what we're driving towards with that. Good example I could think of would be a consulting contract, and as part of that consulting contract, we may go out and recommend that certain products be implemented by our customers or be installed by our customers. We're going to sell that product even though we may not own that inventory of that product. We basically sell it with obtain a profit margin on it, but drop ship it from the manufacturer of the product. And then the question is, for those types of arrangements, do you recognize the gross amount of the revenue, or do you recognize net just the profit margin obtained on that contract? And that's where there's been a fair amount of significant variation in practice historically. And in this case, again, we're not deviating substantially from legacy GAAP, but in the spirit of Topic 606, the focus needs to be on the control, and do we, as the seller of that product, do we have control before it's transferred to the customer? So the two-step process: identify the specified goods or services to be provided to the customer, and then assess whether it controls each specified good or service prior to transfer to the customer. And then on the next slide, we provide some indicators out of the implementation guidance as to when we would be considered, we're the seller of the product, when we would be considered the principal, therefore recognizing revenue at a gross basis. Those indicators are: the entity is primarily responsible for fulfilling the promise to provide the specified good or service. Inventory risk is another consideration, which, again, that's very similar to legacy GAAP. Look at whether there's a right of return. That should be considered in the analysis. And then the entity has discretion in establishing the price for the specified good or service. So just a few indicators as to whether we would qualify as a principal as opposed to the agent. And importance, again, is if we're considered the agent, then we're recognizing revenue at a net basis.
Perfect. And now we have Megan McFarland, our office managing partner from our Dallas office, to discuss oil and gas implications.
Hey guys, so I just wanted to say this is probably a great place for me to jump in, because one of the things that you will see that will impact some of the process we go through to evaluate oil and gas will be the principal agent considerations. That's actually one of the few things that we think will have an impact for the industry. So just to preface kind of what's on these slides are some issues that I had come up with when I had done a presentation prior. And when we saw registrations for this, we decided we needed to have an oil and gas piece, so we're kind of jumping in here. We are behind as an industry on implementation, predominantly because everybody expects our impacts to be minimal. And so what that means is that the implementation guidance that has come out in other industries and other ways has not been as prevalent for the energy industry. But the TRG was kind enough to issue 5 issue drafts on Monday of this week. So we've kind of run through those. The good news is every one of those where it has a line on each one that says impact on industry, the answer is minimal. So hopefully everybody's blood pressure will start going down just a little bit. So what I'm going to do is run through the issues. And the first thing that everybody usually wants to know is what's excluded, right? What do I not need to worry about? So the first thing is operators' transactions with owners. Those aren't revenue recognition. Those don't fall under here. They're not a customer. That's not your normal business, so you don't have to worry about those. One thing to keep in mind with that, however, is if you're a contract operator for wells that you don't have an ownership interest in, you may fall in the revenue recognition guidance, so you'll have to look at that. Inventory exchanges, so say you have product in Wyoming and you're switching that, trading that with another producer in Colorado to get it closer to your contract delivery. As long as both of you are in the same line of business, i.e. both upstream entities, that will not fall into the revenue recognition guidance. Conveyances of oil and gas properties, thank goodness, not in the guidance. Non-monetary property exchanges, and then volumetric production payments will also be outside the guidance. One thing I'll caveat there is historically we've booked the deferred revenue from VPPs into oil and gas revenues in some cases, and the guidance here will require that to be in its own line item or a separate line item from revenue from customers. And then derivatives. Good news. Bad news is you got derivatives to account for. The good news is you don't have to do it under this revenue recognition guidance. The main things to know, the sales method. If you've been using the sales method of recognizing revenue, you will see very few changes in what you're going to be booking. Some of the differences will predominantly be a gross versus net, which I mentioned with the principal agent. One besides that is taxes collected, and this was in one of the resource issues. If you're collecting tax as a courtesy for other owners, that won't be part of the transaction price, which means it won't be in your revenue number. And if you're the person being taxed, then that will be part of your transaction price. So you'll see some flips between what we gross and net there. Like I said on the principal agent stuff, processing costs. So depending on where you consider yourself selling your product, and if you have ownership in the processing facility or you don't. So are you selling to the gas processor at the inlet, or are you selling to the end user at the end of the plant? That will determine whether you're going to record some things gross or net, because it comes down to that control principle. So there may be some differences in how you record, whether you record net revenue or whether you record gross revenue and processing and transportation expenses. Normal purchase, normal sales is usually a good thing because it gets you out of having to account for something under the derivative standard. Bad news is that flips it into this standard. That said, in most cases, your contract price will still work to recognize revenue even if you have a market-based, index-based price. This is kind of wandering into midstream a little bit. The take-or-pay guidance is basically being eliminated, and what that means from a midstream perspective is any excess would be recorded as an asset, a contract asset or contract liability, rather than deferred revenue. We think most fee-based and percentage completion revenue recognition will not materially change. That said, to prove that you've figured all that out, you're going to have to look at every contract, and we all know some people like to make their contracts super fancy, which could put some hitches in them here. And what I said earlier, there will be some gross ups for reimbursement. So if you are a processor and you have a percentage proceeds contract, or you have you retain a certain percentage of the production in lieu of processing fees, there will be some differences in how you're going to record that revenue versus for those services that you provide. From a disclosure perspective, the concern and the thing that's still not completely resolved, and a lot of these things aren't resolved because they become resolved as people start to really implement them, but the disaggregation requirements in the standard are significantly greater than the disaggregation requirements in either your SMOG disclosure or your normal oil and gas disclosures. So figuring out exactly how that's going to work out and how we're going to group those customers and things like that are things that folks are still working through. And then another little hitch in presentation, because derivatives are exempted from this, or not exempted, but don't fall under the guidance, your revenue from derivative contracts will need to be separate from your revenue from contracts with customers, and I know a lot of folks have combined that revenue historically. So that's something that we'll just need to look at, making sure that we've broken out. So those are the big things. I know I had some issues listed on those slides, and I think I've covered all of those just in a different order, but I like to keep things, a little unsettled, so I didn't want to go through them one by one. Overall, it's not expected to be super impactful. The bad news is, to say it's not impactful, you're still going to have to go through all these steps that Greg and Michelle have taught you guys about to evaluate your contracts to show that it's not going to be impactful. So that's all I've got.
Yeah, and I would also add to that as we get into disclosure requirements, those will all be required, at least from a base level, to the extent applicable to oil and gas companies as well. So expect a lot more disclosure. Is that accurate, Megan?
Yeah, that's back to what I was saying about the disaggregation will be considerably different than what we're currently doing.
Great. Well, thank you, Megan, for some insight there into oil and gas. We had a few questions that's come in that we're going to address. The first one being, what constitutes recoverability of the cost implied in margin? So in terms of contract costs, the easiest ones to identify, recoverability really relate to, are they stated in the contract and clearly stated that we're going to charge and be reimbursed for those? But outside of that, yes, it can be implied through margin. It would really be based on how you cost your projects and what the underlying information that goes into that. So, how you price your overall contract and the components of that. And if those are part of those calculations, then I would think you'd have enough support to say they were recoverable. Great. Thank you. Our next question is there an expediency out clause to not recognizing sales commissions as contract costs if they are de minimis, thank you, percentage of the contract value, i.e. 2.5% of the revenue to recognize? So I don't think that there's a clear guidance stating that there's an out clause to be able to not capitalize those costs. I will say, in general, there is the one practical expedient that says if you were going to recognize it over a year or less than a year, you don't have to capitalize it. So there's that component. Then I would generally say in terms of GAAP overall, materiality always applies. So I think you could consider that, discuss that internally and with your auditors to determine how to really approach that and make sure that everybody's in agreement from that standpoint. Okay. Thank you. Our next question is, how much change will there be for a typical widget manufacturer or retail operator? A lot of these examples relate to multiple element arrangements.
Okay. And that's a great question. Maybe first for the widget manufacturer example. My answer would be, I don't want to sound like a typical auditor, but there may or may not be a significant difference. If you remember back to when we were talking about recognition at a point in time, the key concept is control by the customer. And one of the comments I made is that typically we look at currently, I know as auditors, we're typically looking, well, is it shipped FOB shipping point or FOB destination? And that's a determination as to whether revenue should be recognized as it leaves our shop versus when it's received by the customer. I will say that under the new guidance, it's not necessarily that clear cut because just the legal title is not the only determination there. We look at control by the customer. So you might be shipping FOB shipping point, but when you look at the practices of what our company has done historically, we've really maintained responsibility for the product until it gets to the customer's location. So the conclusion very well may be that even though historically we've shipped FOB shipping, we recognize at the point in time that it leaves our dock, under the new guidance, we may come to a conclusion that the recognition really should not take place until it's received by the customer. So that's just one example of how a basic manufacturer could be impacted by this. And some of the considerations we'll be going through both as companies and auditors as this is being implemented. As to a retail operator, what I would say there is I would not expect there to be, from the standpoint of when to recognize revenue, I don't anticipate there to be any difference for a retail operator. There may be some differences in respect to how to evaluate customer loyalty, dealing with returns, rebates, all those sorts of things. But from a base standpoint of when to recognize revenue, I would not foresee much change for a retail environment.
Okay. And we have another question for Megan, I think, about specific to oil and gas. So entitlement accounting for natural gas is no longer acceptable?
That's right, Shannon. Once this guidance goes effective, the SEC will rescind their guidance that allowed the entitlements method, and so it'll be basically that folks will be flipping to the sales method.
Great. Okay. Thank you, Megan. And we have another question. Couldn't disaggregating give competitors too much internal information?
So I'll take a shot at that. Yes. The answer could be yes.
Yeah, and I would say from the energy perspective, just to butt in, sorry, Greg, but
sure, no,
I have
go
a
ahead.
feeling that may be where that's coming from to a certain extent too. Is yes, it will give a lot of information, and that's actually been pretty fervently commented on by the industry. And I think that's why we haven't really had any specific answers on disclosure from the TRG yet that answer how we're going to make those two things interact. But you know, that's the nature of the beast.
All right, thanks, Megan. That was a good answer.
We're going to move on now to our next polling question. Do you feel you have a better handle on ASC 606 revenue recognition for contracts? Please make your selection now. Yes, no, or not sure. Thank you very much for your answers. We actually have another polling question as well. Do you believe this standard will more clearly represent the timing revenues as compared to legacy GAAP? Yes or no?
So it looks like the majority of that is answered yes. Probably a judgmental, no right answer on that one.
We will now go on to our Q&A session. We would like to give our attendees a chance to ask questions. To ask a question, please submit it via the chat box located in the lower left-hand corner of your screen. If we don't get to your question during the webinar, our presenters will follow up with you via email. Our first question is, when allocating transaction price, what if you have a discount and variability in pricing on the specific performance obligation?
So if you have a situation where you do have both discounts and variability in pricing, I think it is my belief that the variability and the criteria surrounding that would take preference. So you would go through that assessment first and then apply the discount from there. I found a few questions and a few discussions within the TRG that task force that certainly had some questions about that, so I believe that's how you would approach that.
Great, thank you. Another question we have, if the determination is made that revenue should be recognized over time, is there any preference or guidance as to which method should be used to measure progress?
Another good question. So, just kind of rephrase is, we talked about there being output methods and input methods as to how to measure progress for recognizing revenue when you're recognizing over time. And is there any preference as to that? Really, the way to answer that is the FASB has been very clear that, again, high level of judgment, but look back to that overall objective, which is to depict an entity's performance and transferring control of goods that were promised to the customer. So the answer to that question is whichever method most faithfully depicts that transfer of goods. So there's flaws in any methodology, to be honest with you. So if you were to think about units produced or the output methods like units produced, units delivered, milestone method, what those don't account for is, for instance, work in process. So it very well may be that that would understate the amount of revenue that should be recognized, as opposed to using an input method, which would measure the amount of labor hours, et cetera, that would go into it. So you're really just going to have to look at your unique circumstance to make that determination, but keep in mind that overall objective.
We have another question. In the first webinar, we discussed the practical expedient of applying conclusions to a portfolio of contracts if the result is expected to be materially correct. Can you do the same with your contract costs?
So I think, it's good to draw this out. There certainly isn't anything in the guidance under ASC 340 indicating that you can use this practical expedient across the portfolios. However, there is much discussion going on, and it certainly seems like it's going to be acceptable to apply that to contract costs as well, if it's going to result in a very similar impact across. But again, it is good to really point out that this guidance, again, is on a contract-by-contract basis, so you do have to keep that in the forefront and think through that in your analysis. And so asking these questions about, practical expedience on portfolio contracts or applying it to a portfolio of contracts are good. So we need to know where our limits are and where we can apply that and where we can't. So thank you for the question.
Great. Thank you, Michelle. Another question that came in, if our company generally just recognizes revenue at the point of shipment, do you anticipate any changes to the timing of revenue recognition?
I think that one's actually very comparable to the one we talked about before as to when control transfers point in time. So
okay. Perfect.
I think we've covered that one.
Good.
Do we have any other questions that have come in? Okay.
Says it that we see. Thank you, Greg and Michelle. In a moment, the attendees, you will be directed to an online evaluation form. Please fill out the form in order to receive your CPE certificate for the course. In order to receive the CPE certificate, you'll be required to be connected to the webinar for a minimum of 100 minutes with 75% of the polling questions answered from your participation. Please allow up to 4 business days to receive your CPE certificate. Thank you again for attending and have a great day.